Dan Zwirn from Arena Investors LP. Welcome to the Alternative Symposium.
Thanks for having me.
Could you expand on the history of and role of Arena Investors in global capital markets?
Sure. We were founded in 2015 in conjunction with a publicly traded partner company, Westaim Corporation in Canada. We operate with nearly $4 billion and almost 150 people around the world as a global opportunistic special situations investor around credit and assets generally. We focus on really trying to create a pool of investments in our main opportunistic funds that are as uncorrelated with the overall market as possible and as inured to idiosyncratic risk as possible through a combination of position diversity and the relative lack of correlation across the different things that we do.
And that broad universe, is it primarily on the debt side of the capital structure or both?
It's not strictly speaking debt, but it's a credit and asset orientation. Just because something's labeled debt doesn't mean you're taking an equity risk, and just because it's labeled equity doesn't mean you're effectively not taking a debt risk. But ultimately, it's looking at the attachment points or where we're taking on risk within any given company or asset and make sure we're as senior as possible, making as much as possible.
And opportunistic probably isn't as well known in Australia. Could you expand on the kind of definitional role of opportunistic?
Sure. I think the key issue is that of moral hazard. So traditionally, folks in our business have really hurt themselves over the many decades by being too narrowly focused and effectively becoming a hammer that only sees nails. And all of these different things within credit and assets are really only opportunistically appealing. So they can be very good or very bad. And so you don't want to be a little bit into them when they're still very bad. And so the key is to have an opportunistic strategy that allows you not only to do what does make sense, but avoid that which doesn't. And so to be able to really look across every permutation of industry, product, and geography and really optimize for the best places where you can find return per unit of risk allows you to avoid the kind of feast or famine cycle that, for instance, you've seen in Australian banking over time.
And do you think that's more or less important in this kind of less or more divergent economic environment we're moving into?
Well, in some ways, this environment is an outgrowth of that approach, of the opposite of that approach. Really, we've had basically a nonstop bacchanal since 2008, fueled by really irresponsible monetary policy and now more recently, very irresponsible fiscal policy. And so you've had an enormous asset bubble. And so a lot of people have raised very, very large pools of very narrow focused capital doing one particular thing because the customers bought it. But at the end of the day, it was a lot of things across the credit spectrum, across corporate, structured finance, and real estate have been grossly overdone. And so now we're kind of seeing the tide finally go out, and we're going to see what's going to happen now.
You've compared investment markets or capital markets to baseball in the past. What
Sure.
innings do we sit in at the moment?
Well, I think with regard to the bubble, I'd said a couple of years ago we were in the 8th or 9th inning. I think we're in the first inning of the new regime, which is really a reversion to the very, very long-term mean. And it's going to take quite a lot of really painful rationalization over likely an extended period of time that will feature a greater level of interest rates and inflation than people expect in order to bring the air out of that bubble.
And do you see any similarities between this cycle and prior cycles?
I think the best analogy I can see that's recent at least is that of post-World War II. And so what happened really in World War II and previous global conflicts was that major governments grossly overborrowed and then kind of expended the use of proceeds, the kind of military personnel and artillery and all the other things that they had to effectively destroy in order to kind of prosecute their what they needed to do in the war. Similarly, we've had, because of this kind of really inappropriate monetary policy that started with QE2 in 2012, we've had this massive asset bubble, and there's a similar hole in our balance sheet collectively that was created by systematically overpaying for assets. And so as a result, you'll see what we saw in post-World War II times for an extended period of time, which was this long-term combination of relatively high rates and relatively high inflation as governments seek to effectively reduce the debt that they have effectively accrued by virtue of this gross over-levering and misallocation of assets. So I think it'll be in the most likely cases, it'll be a long, slow, grinding process of asset realization or rationalization. There are left tail opportunities or risks, geopolitical or otherwise, that could trigger, I would think, something like the fall of '98, where between August and December of 1998, in the wake of the Russian EM crisis and the Thai baht failure and the Asian debt crisis that resulted, you had really no trading whatsoever and a real kind of liquidity shortage.
And could you expand on how you're applying your approach in the local market?
Sure. I think in New Zealand, as an example, we've been very focused on the lack of affordable housing. And so we've actually created, among other things that we do, a structure whereby we are lending to to create the building of affordable homes for New Zealand, where there's an incredible shortage of housing, and at the same time, regular way bank financing for the creation of homes is very limited because of the limited options available to the New Zealand banks, which have themselves gotten themselves into real problems. And so the government has come in, the New Zealand government has come in and created various programs to actually facilitate that, and it's allowed us to finance the development of those homes at really disproportionate return per unit of risk. At the same time, within Australia, we've done special situation corporate lending, structured finance lending. We think a lot of that, we've been very picky in the last several years because the risk reward has been a little tough. But now coming back around, I think we're seeing material delinquencies across corporate structured finance and real estate in Australia. They're going to provide real opportunities.
Dan Zwirn, thank you.
You're welcome. Thanks for having me.